Did you know in 2024, over 145 million Americans had exposure to real estate through REITs without ever owning a single building? No massive down payments, no landlord headaches, no dealing with leaky roofs or late-night phone calls. Just steady income, professional management, and the power to grow wealth starting with as little as $100. The real estate world has shifted and the gatekeepers are gone. If you're ready to find out how regular people are using REITs to tap into billion-dollar properties without breaking the bank, you're in the right place. But how much can you really make with REITs starting small? Which types of REITs are making investors the most money in 2025? And what mistakes could wipe out your profits before you even get started? Watch till end, because the answers might just change the way you think about real estate forever. Understanding REITs. REITs are like the cheat code for real estate investing. Instead of buying property yourself, you buy shares in companies that own income-generating real estate, everything from apartments to hospitals to data centers. These companies are legally required to hand over 90% of their taxable income to shareholders. That means steady dividends hitting your account while someone else handles all the messy stuff like repairs and tenants. There are three main flavors of REITs: equity REITs, which own buildings, mortgage REITs, which own debt, and hybrid REITs, which do a mix of both. Each type moves differently with the market, but the goal is the same: consistent cash flow backed by real assets. 2024 to 2025 REIT performance. If you think REITs are boring, think again. In 2024, specialty REITs skyrocketed by nearly 36%. Data center REITs, the places that literally power the internet, jumped over 25%. Healthcare REITs surged more than 24% thanks to aging demographics and rising demand for medical facilities. Even when traditional stocks were all over the place, some REIT sectors quietly crushed it. Sure, interest rate hikes threw some cold water on the party, but smart REIT investors who chose the right sectors still came out smiling. That's the hidden beauty of real estate investing. Through REITs, while the headlines scream chaos, the right properties quietly make money. Advantages of investing in REITs. First off, you don't need a six-figure bank account. Some REIT ETFs let you start with pocket change, literally a few dollars. You can even automate your investments, setting it up like a subscription, so you're steadily building ownership over time. And because REITs are traded on major exchanges, just like stocks, you can buy and sell fast without waiting months for a property to close, without agents, and without stacks of paperwork slowing you down. You're also getting built-in diversification without even trying. One REIT might own dozens, even hundreds of properties across different cities, states, or even countries. Office buildings, shopping centers, healthcare facilities, industrial warehouses, all bundled into a single investment. If one building loses tenants, others can pick up the slack and keep cash flowing. Plus, those regular dividend checks aren't just nice bonuses, they're a serious piece of the total return puzzle. Historically, dividends have made up nearly 45% of REITs' overall returns over the past few decades. And here's the kicker: professional management. You're not handling late-night repair calls, chasing down unpaid rent, or negotiating with stubborn tenants. Experts who live and breathe real estate do all the heavy lifting, while you get to sit back and collect the rewards. It's passive income in the purest form. Potential risks and considerations. Now, let's not sugarcoat it. REITs aren't magic. They're powerful, but they do come with real risks. When the stock market drops, REIT prices can tumble too, sometimes even harder than traditional real estate values. They're sensitive to interest rates. When borrowing becomes more expensive, real estate profits can shrink fast, dragging down REIT performance along with it. Taxes can bite a little harder too. Unlike qualified dividends from many stocks, REIT dividends are usually taxed as ordinary income. That means, depending on your tax bracket, you could be paying more than you'd expect, a detail that surprises a lot of first-time investors if they don't plan ahead. And while many REITs are built like fortresses, not all management teams are created equal. A poorly run REIT can wreck your returns even in a strong economy. Bad investments, poor tenant retention, sky-high debts, these problems can sink a REIT faster than you think. That's why doing your homework is absolutely critical. Look beyond the flashy yields. Dig into how the REIT is managed, what properties they own, how much debt they're carrying. Never throw money into something just because it sounds good or promises high returns. In real estate and in REITs, boring, steady, and well-run usually beats flashy and risky every single time. How to start investing in REITs. So how do you jump in without stepping on landmines? First, open a brokerage account that gives you access to REITs and REIT ETFs. Most platforms today like Robinhood, Fidelity, or Vanguard make it simple. Some even offer fractional shares, letting you start with just a few dollars if you're testing the waters. Next, don't just grab the first REIT you see. Look at their portfolio. Are they focused on booming industries like data centers, healthcare, or logistics? How's their dividend history? Strong management and smart property picks matter more than hype. If choosing individual REITs feels overwhelming, no problem. REIT ETFs bundle together dozens of REITs, giving you instant diversification and saving you hours of research. Start small. Watch how different sectors react to news. Healthcare REITs, retail REITs, storage REITs, each moves differently. The smarter you invest from the start, the stronger your gains over time. Spotlight on high-performing REITs. Some REITs have absolutely crushed it lately. Take Vici Properties, for example. They specialize in casino and resort properties, basically playgrounds for adults, and they're throwing off a juicy 5.3% dividend yield right now. Then there's American Healthcare REIT, which exploded by 125% last year, riding the wave of booming medical real estate demand. And don't sleep on extra space storage. In an age where everyone's buying more stuff than they have room for, storage units have quietly become one of the steadiest profit machines out there. Each of these REITs had a smart focus. They didn't chase every shiny object. They specialized, stuck to their strengths, and reaped the rewards. REITs in 2025 and beyond. What's next? The forecast looks surprisingly bright. Experts predict REITs could deliver 10 to 15% returns in 2025, especially if interest rates stabilize or even start to fall. Data centers, healthcare facilities, and specialized REITs tied to logistics and e-commerce are all primed for more growth. As more businesses move online and more people seek better healthcare, the properties behind those industries become more valuable. But here's the smart move: stay flexible. Watch interest rates, keep an eye on emerging sectors, and never bet your whole future on just one trend. Even in real estate, adaptability is the secret weapon. Owning real estate doesn't have to be a fantasy reserved for the rich. Through REITs, anyone with even a few bucks can start building wealth backed by real, tangible properties. You don't need huge loans, massive risks, or a second job managing buildings. What you do need is a bit of research, a steady hand, and a willingness to think differently. Real estate investing isn't about who has the most money, it's about who plays it the smartest. If you found this guide helpful and you're serious about growing your money smarter, smash that like button, drop a comment about your favorite REIT or one you're watching, and hit subscribe for more real-world investing tips. And don't forget to ring that bell so you never miss a chance to level up your financial game.